When is the best time to invest? Should I buy stock now or wait? In these times of uncertainty, talking about investing and the economy may seem intimidating and scary, especially for first-time investors. However, that doesn't have to be the case. If you are an interested investor, success involves having a good amount of knowledge of how the economy and the market interact with one another. It is a valuable skill that anyone, even you, can learn and develop. Tens and thousands of people search Google for the answer to the question of whether it is a good time to invest in stocks. It's a tricky topic, and the answer depends more on the goals you have for your investments and the time frame you have in mind than it does on how the market is performing on any day. Hi, this is Finance Bureau, your one-stop place where you can find anything finance related. And if you're looking for advice that will help you with your investments, you'll love this video. Just keep watching. In this video, I will be walking you through and answering the question, when is the best time to invest? Should we invest right away, or should we wait a little longer and see if the stock market falls even more? But first things first, we need to learn and understand what investing means to get started. According to Investopedia.com, it refers to the practice of putting resources such as money into something like assets with the hope of earning a profit at some point in the future. If I put it quite plainly, in the basic sense, investing allows your money to work for you rather than the other way around, with you having to work for your money. The second question you need to ask yourself is how hard you want your money to work for you. Like almost anything else in life, if you want a greater reward, you must be willing to take on more dangerous and higher risks. There are many possible pitfalls that you might encounter when investing. However, when you are armed with the right knowledge and exhaustive preparation, you might avoid things from going wrong in the first place. When investing, you should research about the things you plan to own, as well as the potential risks that come along with it. There are numerous factors that affect the value of investments, but the economy, especially the economic forecast, are the most essential. Why is this so? The COVID-19 pandemic has stopped anyone going to work or school. A lot of enterprises and shops had to close down permanently because of the drop in sales, and a lot of people lost their jobs as a result. The value of investors' assets, especially the stock market, plummeted as much as 40% in a couple of days due to the sudden downturn in the economy. The shocks and downfalls that we witnessed during the pandemic is something that we can use to learn and study how the economy affects investments. The value of investment assets dropped before our eyes as we saw firsthand what happened when the economy goes bad. This means that as the economy stabilizes and shows indications of recovery, we should start to see a rise in the value of investment assets. Because of this, having a solid grasp of the state of the economy as well as its outlook is an essential component of any process involving investment decisions. That is why in this video, we are going to tackle and analyze important economic indicators in deciding when's the best time to invest in 2022. An excellent place to begin would be to explore the gross domestic product or GDP, inflation, and unemployment rates of the country. These are the top 3 economic indicators that are known to be the most crucial in considering when to invest. Taking a closer look at these economic indicators will give you a general idea of the state of the economy at that particular point in time. Monitoring the changes that occur in these indicators over a variety of time periods will help you in determining economic trends, which will in turn give you a notion of the overall path and outlook of the economy. Let's jump to the first economic indicator we should look out for, the gross domestic product or the GDP. The gross domestic product, which is the total monetary worth of all products and services produced in a nation over a certain time period, is the measure of the size of the economy that is most generally used. Therefore, positive growth is desirable, but negative growth, often known as a fall in GDP, is undesirable. As a result of the ongoing health crisis, the economy of every nation all over the world is expected to decrease. It is crucial that you keep in mind that the market is forward-looking even though there have been 2 consecutive quarters of negative GDP growth in the United States during the first half of 2022. This has led to worries of a recession. Future expected earnings are the primary factor used to evaluate stocks. In addition, even if there are fluctuations in GDP from time to time, profits typically go up in the long term. Despite this, there are still profitable stocks in the market to purchase during during a recession. I believe it makes sense to get straight into one of the most significant challenges facing the economy right now, and that is inflation. What is inflation? An economy is said to be experiencing inflation when there has been an overall rise in the prices of a typical basket of goods and services. Increasing prices of commodities may be seen as a negative development. Nevertheless, some degree of inflation in the economy is really beneficial. This is due to the fact that it signals a strong demand for products and services in the economy, which is of course a good thing. So going back, the last but not the least, you should also take into consideration unemployment. Unemployment is a measure of joblessness that is represented as the proportion of persons who are actively looking for work but are unable to find work. The value of this number should ideally be as low as possible. Clearly, the lower this number is, the better. Are you learning something new or productive so far? Please feel free to let me know what you think about these key economic indicators by leaving a comment below. So, going back to the video, when we have a thorough knowledge of how these key economic indicators impact the economy of a country as a whole, we now can apply that to see how it influences the stock market. For the next part of this video, I will be talking about the stock market and financial markets. For starters, according to Investopedia.com, the term stock market refers to several exchanges in which shares of publicly held companies are bought and sold. Such financial activities are conducted through formal exchanges and via over-the-counter or OTC marketplaces that operate under a defined set of regulations. Moreover, the stock market is comprised of the biggest companies in the country at the present time. An indication that the economy is doing well is when the GDP is growing at a reasonably fast rate, a stabilized inflation, and the unemployment rate being relatively low. At the same time, if everything else stays the same, these companies should be doing well and should enjoy substantial sales of their goods and services, which should, in turn, result in high profits. If this is the case, it should indicate that the company is expanding, which should then result in an increase in its value. To explain this further, when you purchase a share of a business stock on the stock market, you automatically become the owner of a portion or share in that company. As a result, the price of a share will increase according to how valuable the company gets. So for you, my dear investor, to be savvy, you must know how to read the signs and look ahead to changes in the economic trends, such as when things are about to go bad or the other way around. These trends will very certainly have an impact on the company in which you own a share, especially the value of that share. When it comes to financial markets such as the stock and bond markets, they can be thought of as a supercomputer, a thing that instantly calculates a market value or price for a stock or bond, depending on the expectations of all the buyers and sellers out there in response to everything that is occurring around the world at any given moment. These market values are continually shifting, always changing as each new expectation is priced in, since individuals have varied ideas and opinions on what to anticipate in the future. This is why the market is in a state of continuous motion. They may be rather moving at times, particularly during periods of tremendous unpredictability, as was the case during the height of the pandemic. This is where the term volatility comes in. It refers to the fluctuation of prices over an extended period of time. So, it really helps to become a savvy investor to become successful. A savvy investor is one who can maintain their composure and not be swayed by their emotions at times of high market volatility, when prices are moving quickly in unpredictable directions. Because we are just human, and the forces of fear, desire, excitement, and terror are in fact extremely powerful, this is something that is far simpler to say than it is to put into practice. How do you become a savvy and successful investor? You put yourself in a more advantageous situation when you try to research and get a deeper understanding of how things work before investing your money. You must be aware of the dangers involved and have an accurate understanding of the extent to which you are ready to accept and take risks. I'll say this again. The size of the potential reward relates directly to the level of risk that one must be willing to take. Investors that are successful are often individuals who are constantly educating themselves, making plans, and have a lot of patience. When you have this information at your disposal, you will be able to make more informed choices about your investments, regardless of how volatile the markets may be. This process of never-ending education needs to include having consistent conversations with a reliable financial advisor who has a clear understanding of highly complex market conditions. My last advice is, if you are someone with some savings to invest, someone who feels ready to buy stocks and don't need the money for at least 5 years, then it is safe to say that you should dive right in. If you are invested for the long run, you will still have time to recover losses even when the market is at its lowest point, which has occurred very often in 2022. Remember to do regular checks and assessments of your investments. Investing money and then completely ignoring it is not a good strategy at all. You should make it a habit to check on a regular basis how well your assets have performed over a certain amount of time. Yesterday was the best day to start investing. If you missed it, you should start investing today. But don't forget to be smart and savvy. Hey, did you learn something from this video? Make sure you hit that like button to subscribe to my YouTube channel for more finance content. Now, I want to turn it over to you. Do you already know when is the best time to invest in 2022? Do you see yourself as a savvy investor? Are you going to try to becoming one? Let me know by leaving a comment below right now. Thanks. See you on the next video.